So good morning, everyone, and thank you so much for joining us this morning on our EDC Coffee Chat. I want to thank both Andy Callis, the owner of Callis Insurance, and Mary Patzman, the Employee Benefits Manager of Callis Insurance, for joining us today. If you guys probably have heard, since you've joined this coffee chat and what appears to be a fairly mundane topic of long-term care insurance, know that the state is planning on implementing a new payroll tax on January 1st of 0.58%. And Andy and Mary are here to talk about that state program and what alternatives are to the program to make sure that you have the best option for yourself or your employees. I understand that self-employed people are exempt, and they'll go over all of that kind of information. But from a process standpoint, if you have any questions, you can go ahead and put your question into the chat, and and Andy or Mary will answer those questions for you at the end. I'll call on you to ask your question. And then, we'll reserve those questions to the end. And this video will be posted on our website, Choose Clallam First, under the Colleen Coffee with Colleen tab there. So thank you everyone for joining us. And I'll start with Andy. I'll let Andy take it away, and he can start sharing the slides. Great.
Perfect. Well, I've just shared my screen, my first slide there with you. So as you make adjustments to your screen, I'll talk a little bit about Callis Insurance so you know who we are. We're an independent insurance agency based in Port Angeles. We have 2 offices, one in Bremerton as well, and here in Port Angeles. We have 12 employees. We do personal home, auto, business insurance, nonprofit insurance, and of course, employee benefits, so life and health and other related lines. A little bit about myself. Click this. So I'm the president of the insurance of Callis Insurance. I've been back in Port Angeles since 2006. I mainly work with commercial customers and nonprofits on property and casualty insurance. Mary Patzman, she's our employee benefits manager. She's been with us since 2016. She has over 25 years experience in employee benefits and HR. She has extensive experience with that. So our topics today, we're going to talk about the long-term care tax, what the program is, basically the how, the what, and the why, how you can opt in, how you can opt out, and then some alternative options for you in the private sector. And if we have time within the Q&A, we will also touch base on some a little bit more detailed stuff about unions, moving out of state, and other topics like that. So we do have a lot of information to cover, so I'm going to go pretty quick on these. I will speak fast just to make sure we have adequate time to answer all the questions you guys do have. So do encourage you to do that and reach out to us after the fact if you have more questions. So key terms this morning, long-term care insurance. A lot on the slides are going to be abbreviated as LTC. Basically, it's used to describe a policy or insurance plan to basically care for a person either in a facility or at their home if they lose the ability to perform activity daily living type items. So being able to shower or make food, things of that nature, or diagnosed with a cognitive disability. Long-term services and support, LTSS, is the term the state's using basically, and it does, we expand upon what is a little bit different. They add a definition, a few more services within their definition of long-term care. And they also say that LTSS is basically 3 or more of those daily living activities. They abbreviate to ADLs. So the key thing here, though, is long-term disability insurance or short-term disability, or the PFL-ML, are income-based things versus, so if you lose your income, your ability not to work or receive income, when long-term care is actually the care of a person. And so that's what we're going to be talking about today, is the actual care of a person, not income replacement. And so that's the big difference here. So two obviously major government programs that you see, Medicare and Medicaid. Medicare is more of a federal-based stuff. Medicaid is more state-run. It does have federal money come in, but it's basically taken care of by the state. So Medicare itself can pay for skilled nursing care, short-term recovery, not long-term, but short-term, and a few other things here. Basically, it does cap at 100 days of service, so it is not, again, long-term, it's short-term, and you have to have Medicare. So if you are not on Medicare, you don't have this ability for that. It does not cover true assisted living facilities, nursing homes, personal care, or supervision services. That's where the long-term care comes in. Medicaid itself has an income limit, so to qualify for Medicaid, you have to have these different qualifications. So basically, a low standard of income coming in. You see the monthly limit there. You have to be on Social Security income. Basically, the state has control. They look at your assets going back, 5 years to see, make sure you don't have the income, so that you would then qualify for Medicaid. So you can see there is somewhat of a gap here if there was long-term care needs. So basically, with Medicaid, your home health care is pretty limited. So this is kind of the why. So basically 7 in 10, this is what the state's telling us. So basically 7 in 10 will need long-term care services within their lifetime. So that means if we have however many people here, let's say we have 100 people on this slide, that means 70 of us are going to need long-term care at some point in our lives. Most of these Medicare plans cover very little of the long-term care. So past that 100 days, you don't have that ability. So that's where they're saying there's a gap. Medicaid long-term care actually requires you to spend down all of your lifetime savings, all your assets, basically qualify for Medicaid. So you get put in a very negative financial position before you qualify for the state benefit. So the majority of seniors usually rely on family or Medicaid for their care. And so again, they're saying that's why we need this to be back funded here. At this time, we have about 850,000 in our state that are unpaid family caregivers. So that equates to some other statistics that we talked about. So continuing the why, basically we need to create a trust, is what they're doing, to save money for the future demand that we see. And so in 2030, it's estimated that the state Medicaid long-term care will be at $4 billion. And so we're basically the state's trying to nip this in the butt before it happens, before we get into debt for this long-term care on the Medicaid program. The long-term services payment is about $387 million, and they're hoping to fund that through this new payroll tax that we were talking about today. Annually, right now, the state's spending $24,000 for in-home care on average, and $65,000 for nursing home residents. So you can see where those numbers, if you multiply them out, how many people might need it, those expenses add up very quickly. So long-term care insurance, like I said before, is a little bit different what the state defines as long-term services and support. The moniker for the state plan is Washington Cares, so they make it sound really like we're caring for us. So long-term care insurance is professional care at home and by a licensed residential or at a nursing facility. The services and support section of Washington Cares defines it further and says home safety evaluations, home delivered meals, training, paid, and support for family members who would support someone that does need long-term care, rides to the doctor, different types of equipment like wheelchair ramps, stuff like that, lifts, and then technology for medication reminder services and anything else that comes up in the future as far as technology is concerned. So those are things where the state's kind of expanding that a little bit more, for food and things like that. So, so the actual long-term care trust, the amount starts at $36,500. So you're paying into your taxes into this program. That is the cap of the limit they'll pay out. That's equivalent of what they call units. And it's $100 per unit, and you get 365 units per lifetime. So it's a little when you say unit, it's basically like a service essentially. So you can maybe split units and things like that. There's ways you can use it part of a service for a day, but not the whole day, so you don't use a whole unit. And you can also stack units per day. So truly, you can't say units are days of service. It kind of can be used up faster because you're using separate units for services. We don't have a list of those units, what they are defined at in this slide. That stuff will come out later, but you can see that if you had be out for a couple months or I guess past 100 days for long-term care, you're going to use those units up very quickly. And there is no automatic increase on the Consumer Price Index in Washington at this point. Now, how do you qualify for the benefit itself? So you have to be 18 years or older when you apply. You have to be a Washington State resident, and you will forfeit your benefit and your premium you paid in if you move out of the state for over 5 years. There is a vesting provision, and so once you're paid into the program over time, over 10 years or 5 years consecutively, you're permanently grandfathered in on the vesting side of it. Temporary, you're paid in 3 of the last 6 years. You must work a minimum of 500 plus hours in the qualifying year, which isn't much if you think about it, but ultimately they do have a limit for that. And then you also have to have your 3 daily living activities lost, not normally 2, which is what insurance in the private sector typically will cover. So 3, again, like showering, be able to prepare food, change yourself, those type of things are those daily living activities that they qualify. So you have to lose 3 of those to qualify for the benefit. So the assessment or cost to all the people of Washington is 0.58% of your wages. There's no cap on the wages, and then it also immediately starts January 1st of this next year. It typically is going to be employee paid. It's not required by the employer to pay it, but they can opt to do that. And then rates are reviewed every 2 years. So we don't know if 0.58% in 2024 is truly going to be 0.58%, or is it going to be 0.65%, or is it going to be 1%? We don't know those amounts yet. In the wages that are included, it's your base salary, your bonus, your commissions, overtime, even vacation and paid time off that's required by our state now. Termination settlements, that's going to be your golden parachutes if you have them still, and then cash value of any other type of compensation. Things that are not included, which is nice, they at least have something not included, tips. So like I just got a coffee at the Daily Grind. So the tip that I left the gal there is not going to be included in that. And then also a few other items there. So from that standpoint, you can see where the cost to a consumer can be varied, and it is truly an employee tax. So with that, I'm going to have Mary take over, talking a little bit more about what the requirements for employees are, employers, and what the opt-in, opt-out, and then also, in addition to that, she can talk about the alternatives that we have out in the marketplace. So, Mary, go ahead.
Thank you. So, as an employer, your responsibility to begin with is to set up your payroll, to take that deduction from any employee's paycheck that opts not to purchase an alternate or a long-term care policy for themselves. When you get a waiver, and in a minute I'll talk about those waivers, you need to keep that on file, and those have to be submitted to ESD. And then, of course, you're going to have to educate employees, tell them about the state program, tell them about how this might affect their retirement, how to opt out, and then talk about offering a group-sponsored long-term care policy. You can, thank you. So we want you to learn about the state program, which is really what we're here today to talk about. We want you to learn about long-term care insurance, and then decide if you want to opt out of the tax and opt into a long-term care policy, or just stay with the tax. There's some dates here that are pretty critical. You must purchase and be begin paying for a long-term care policy by October 31st, or you will never be eligible for a waiver. So never. If you don't have that in place by October 31st, you will never be able to waive that tax. You have to apply for the waiver by December of 2022, which is a long time. But if for some reason you don't send in your waiver to the state, they'll give you until the end of 2022 to get that in. The caveat there, if you send that waiver in late, you're going to end up paying that tax until the waiver is approved. So whenever you send it in, if you send it in December and the state doesn't have a chance to approve it until January 20th, you're going to pay 1 full quarter of taxes in addition to your long-term care premium. So staying on these deadlines is very important. And then an employee, you need to give the waiver to your employer. So you give them a copy of your waiver. If you sign up for a plan, that plan is going to send you the waiver form. You give it to your employer, it gets filed with the state, hopefully pretty timely, and you're all set. And I talked a little bit about qualified long-term care insurance. Again, purchase that policy, have it in place October 31st or November 1st. You apply for the assessment exemption. That exemption can go in between October 1st and December 31st of 2022. So October 1st of this year and December 31st of 2022.
Morning, I'm doing the EP.
If for some reason your waiver is not approved until into 2022, so again, that situation where it's not approved until January 20th, you are still going to pay a full quarter of that payroll tax. If you opt out, it's permanent. There is no going in the Wayback Machine to put a plan in place. It's permanent. So the decision has to be made and the plan has to be implemented by October 31st. So what I'm finding is initially when we started talking about this several weeks ago, 3 or 4 weeks ago, there were numerous carriers out there willing to write groups, all the way down to 2 employees in a group, which is great. Well, they stepped back from that, and now we're moving up. So they're getting overwhelmed. The carriers that do offer long-term care, they're getting overwhelmed. So the earlier you apply for a policy, the earlier you apply for a group policy, the better your chance of getting that approved is. So we're suggesting by July that the initial information goes out for a quote to the insurance companies. We want you to be able to be, in that group that are eligible for a long-term care policy. So these are the alternatives. Your first alternative, pay that tax, the state LTSS program, Washington Cares. You have to be in Washington to receive those benefits. There's no cash value. There's no return of premium. In this case with the state, that return of premium is return of tax paid. There is no health underwriting, so that's appealing to a lot of people. The next option is long-term care insurance. This is because of the way the market is rating at this point, that long-term care insurance, that middle column would be more for a larger group, 500 plus employees. And they would get a relatively inexpensive long-term care policy. But again, you have to be the larger groups for that to be issued by companies. Obviously, more people putting premium into that, the better chances that there'll be enough premium for them to pay any claims. This last option here, this one I'm really kind of excited about, and we're going to see this a lot for our smaller employers, pardon me, in the county. It's a life insurance policy that has a long-term care rider attached. So you purchase this policy, it has life insurance, and it has long-term care. As you're moving along, maybe you never make a claim. Your beneficiary is going to get the full death benefit. Let's say you do make a claim, but don't use all the money. Your beneficiary would get back whatever is left. So if it's a $40,000 policy, you use $20,000, your beneficiary is going to get $20,000 upon your death. I think it's a really smart way to do that. We can go ahead, Andy. So if I can just really quickly take a moment to go over some really common questions. Who doesn't have to pay the tax? If you are a 1099 employee, if you are a tribal employee, if you're a federal government employee, and anyone who is self-employed, so a sole proprietor. You can opt into that tax and pay it if you want to, but you don't have to. The benefit you're going to be getting through the state program is pretty skinny. $36,000 is not going to go very far at $100 a day. There's no care out there that you can get for $100 a day. And you also have to use the state providers. So you may say, I want to go to this facility that is closer to my children. If that's not a state facility, they will not allow you to use it and they won't pay a benefit there. Okay.
Wow.
Union workers. If you're under a current collective bargaining agreement, you will not be responsible for that tax until the agreement is renegotiated. However, if you want to purchase a long-term care policy that will waive that tax in the future, you still have to do it before November 1st of this year. So on the one hand, you're not going to be paying that tax until you renegotiate that agreement. But this is your only chance to opt into a long-term care policy. Okay. If you have an employee that works in Washington, lives in Oregon, if they're doing any hours in the state of Washington, tax is paid for those hours working in the state of Washington. So an Oregon-based employer that has remote employees in Washington, they will have to pay that tax. If it's an Oregon-based employer and they have someone that comes into Washington 3 days a week to work, 3 days of tax will have to be paid for them. This is like shadows back to me to when paid sick leave first came around in San Francisco and huge companies tracking their paid sick leave due on spreadsheets. It was not easy. It really wasn't. Okay. So the employer responsibility again, collect the premiums. The premiums rather collect the taxes, remit them the same way you would with PFML. So if you have somebody that you pay PFML taxes for, they are also going to be responsible for this tax, for the long-term care tax. There's no employer contribution to this, none at all, no required. Some employers are opting into a group long-term care policy for their employees and are paying a portion, but you don't have to. That's a business decision for you to make. Okay. So once an employee receives a premium assessment, could you ever opt back in? So you buy a policy and you decide, you know what, I would rather pay the tax. You can't. Once you've opted out, you're never going to opt back in. And I've had this question a couple of times already. Can a retiree opt into the LTSS program? And no, you can't. This is an actual payroll tax, so you have to be working in order to pay the tax. Okay. And then again, as self-employed person, once you opt in, if you choose to, you can't opt out. Let's say you're a non-W-2 person and you did not opt in and you did not put a long-term care policy in place for yourself before November 1, you can't opt in. If you go to a W-2 position, you're going to pay taxes, even if you were non-W-2 when you first started. Okay. So benefits are transferable. So if you purchased a long-term care policy, it's what we call portable. You get to take that with you. So you take the policy with you and you arrange the payment directly with the insurance company to continue those premiums. You go to your new employer, you give them a copy of your waiver, and they won't take the tax. Okay. And I think I just mentioned that the assessment waiver is transferable to the next job because you can take your long-term care policy with you. If you have a waiver, but you don't give it to your employer, they have to take the taxes. So it's just something that someone needs to remember. If they change employers, they have a long-term care policy, remember to give the new employer your waiver. Okay. This is a question that's come up more than once. What if I don't want to pay that tax? If you do not collect a tax from employees and do not remit it, it eventually will come back to the employer. And the employer is going to be responsible for that full amount. So if you don't collect and pay the tax for 6 months, ESD is going to come around, knock on your door and say, what about these 6 months? As an employer, you're going to be on the hook for that. You can't go back to your employee and say, okay, now on your next paycheck, we're going to take 6 months of taxes out because I forgot to pay them. So just keep that in mind. Okay.
That was the last slide of
the last slide. Couple things.
There's more.
Let's say somebody is 60 years old. They're planning to retire when they're 62. They will have only paid 2 years into, and they're paying the tax. They would only pay into the tax fund 2 years. They would not have enough credits in that program to get the tax, or pardon me, to get the benefit. So the older a worker is and the closer to retirement, the greater chances are they will pay that tax and not be able to use the program. Also, if you have a kid that is, say, working at McDonald's or washing down the carts at the golf course, and they're under 18, they are forever opted into the tax. Somebody under 18 cannot execute a contract for long-term care insurance. So just because they're working at 16 and then they become an adult, they decide, I don't want to pay this tax, I want a long-term care policy. They can certainly buy one, but it's not going to exempt them from the tax. And this one, and I think we talked about this a little bit. If you are the owner and you're paid wages from the company, you are considered an employee. So if you are a W-2 employee, you're going to pay the taxes. No cap on that. You know, so some business owners earn a significant income, and at 58 cents tax on that, it could be huge. So in those cases, it would be to their benefit to get a long-term care policy. And then just briefly, we can do a comparison for you based on wages and what the tax would be. So you can take a look at that and see which is the better way to spend my money. Okay. And that's just the long-term care statute there. Okay.
So Colleen, that was the last slide. I know we've got some questions that came in. So do you want to go ahead and start calling people out? That'd be fine.
Pardon me.
Yes. Okay. So let's start up at the top here. So Michael Smith, I know you had some questions. So do you want to start with the first one?
Okay, so somebody buys, either they opt in to a group and opt out of the state program. And so they have their exemption from tax. And now a year goes by and they cannot get back into the state program and they lapse their policy. What happens then? Are the insurance companies just going to have all these people buying insurance for 1 year and dropping it just to get out of this tax?
Great question. Right now, there is no recertification process put in by the state. So there is that potential that somebody purchases a long-term care policy either on their own or through a group and potentially stops paying those premiums. They're opted out of the tax fund. Currently, no recertification process in place by the state. That could change. But right now, the answer is it could happen.
So you've mentioned a lot of issues with the program. I'm particularly concerned about people who are under 18 working who don't really have the opportunity to opt out and they're in it for life. Is anybody going to consider amending this or correcting it? And also, I have some employees that are over 65 at this time. Are they able to start getting this benefit? And how long do they have to pay in and keep working, you know, to get the benefit? And does it mean they never can fully retire to get this state benefit? They always have to keep working 500 hours a year forever.
So to qualify for the benefit, you have to have at least 3 years paid into the tax, or into the tax fund. So if somebody is 62, planning to retire at 65, they will have their 3 years in. What's sticky there is if they need to make a claim on that state fund, they have to file that within 3 years of them retiring. So by the age of age 68. If they need benefits when they turn 70 and they only paid in for 3 years, they won't be able to get that state benefit. These things could change, in particular with the under 18 employees. You know, there's been some few amendments to it so far. We're hoping for more, just to make it a little more equitable for people.
So we've got Representative Tharinger, who's got his hand up and obviously is a part of the crafting of the program or modifications of the program. So Steve, do you want to comment?
Yeah, thanks, Colleen. Great presentation, Andy and Mary. I think you defined the problem for the state, that there's just this huge obligation and folks don't understand that Medicaid doesn't pay long-term care unless you spend down all your value. So the idea is to provide some alternatives here for folks. I'm just trying to wonder, you know, for some of these products you're offering, like the life insurance with this long-term care option, or this group long-term care? Do you have a sense of what those premiums might be per individual? Because
For a group,
the long-term care option, right, that the state's offering is 58 cents per $100 of earnings, right? So that's not a huge obligation. You call it a tax, and it is an employee tax. There's no question about it, but it's a fairly de minimis amount. And the way the actuarials have worked out, if you are in the program for long-term, you will have put in about $9,000, which will get you a benefit of $32,000. And the thinking around that, it's not a huge amount, right? But the thinking is that would provide you at least another year or two if you're living at home. The whole state strategy of long-term care is for having people to be able to age in place and age at their home. And these dollars, you can pay a family member as a caregiver. And that, I think, Andy, when you mentioned the 850,000 unpaid caregiver, most of those folks are family members that are not being paid. This program will allow the individual who's in the program to pay that family caregiver. The person gets to stay at home and age in place, which I think is a goal that all of us would like. Plus the idea of saving, hundreds of millions of dollars in Medicaid costs for the state. But I'm just wondering what those average premiums might be in some of those products that you guys are offering, either in the insurance and long-term care piece or in the group long-term care.
Sure.
Did you want to get
Mary?
that one, Andy, or?
No, go ahead, Mary.
Okay. In a group policy, if there's some advantages there. You're going to get slightly lower premiums than you would if you went to purchase your own policy. So if you get an individual policy, you'll have less premium going into that policy than a whole group would. So the thought there is similar to what the state is. You put the money in the fund and then it's going to be taken out and paid. Rates for a group policy tend to be lower, and underwriting tends to be easier. So on an individual side, they're going to ask you about all of your systems. So neurologic and cardiovascular, all of your body symptoms. So it could be a little more difficult underwriting on an individual basis. On a group basis, they tend to ask you two questions. Have you been hospitalized in the last 6 months? And do you have HIV? So it's a little bit easier underwriting. And speaking to the actual premium, it's difficult to say. And that's why we will run a comparison for you. So we'll run a comparison that says, this is what you would pay based on your current salary as the tax. And then if you choose to spend that money differently, this is what it would cost you to purchase a long-term care policy in a group setting. Yeah,
So,
I think I
Colleen,
touched on that.
Colleen, if I could, when we, and folks may know, I chair a joint executive legislative committee on aging and disabilities, and we developed this program about 4 or 5 years ago after doing some actuarial studies, because the long-term care insurance market has imploded. And it was just not, people were losing thousands of dollars, tens of thousands of dollars that they paid in premiums, and then this care wasn't there. So we needed to come up with an alternative, and this is the alternative. It's the first one in the country. There are other states looking at it. But the challenge is that, it's just very difficult to make this work in the private sector. One of the things that's in the bill or in the policy, much as in Medicare Advantage plans, the private sector can add supplements. You can go out and buy a supplement, sort of an Advantage product through the private sector to help supplement this. It addresses some of the issues that Mary and Andy have talked about, the lack of flexibility between states. That's a real issue, no question about it. And some of the limits. But there's actually language in the bill that says the healthcare authority, which is the administrative agency here, must work with the private sector to help develop those products to help supplement the program. But this is really meant for folks that can't afford a lot of the products that are available in the long-term care, marketplace. I will say that the industry is starting to step up, and the goal for everyone, I think, is that there is some sort of insurance, some sort of coverage for long-term care, because we're all living longer and those costs are real. And having to spend down all your value, all your equity to be able to be eligible for Medicaid, as Andy mentioned, is just not a great option. So the idea of this is to work with the private sector to help supplement and fill in some of the gaps. I think Mary's right. Some of the actuarial stuff is a challenge because it's a new program, and the trying to figure out what, as insurance folks know, those long-term actuarial sort of figures and how those work are hard to figure out, and so you need to kind of cover. I guess be conservative in how you manage that.
So Steve, to piggyback that just a little bit, so when we were talking about the lower rate, that's the group's 500 plus employees. So what the state's trying to do is fill in the single person or that doesn't have that accessibility, and so we totally understand that. So when she was giving you that answer, just so you know that the lower rates were based on the larger employers, not on the smaller employers, which obviously in our county and area is more prevalent here. So that's why we do talk about that third product, which is probably what will be, from our clients' perspective, get inquiries. That's kind of what we're leaning towards if they're not opting to the state, just because of the size of our average employers here in our area. So for sure.
And we're happy to do that premium comparison and quote for you. Just email us at benefits@callisinsurance.com or email your questions there too. And we're happy to try to quote this for you and help you look at it and help your employees decide what would be best for them.
So Priscilla had a couple questions.
Yes, I was wondering, well, first, it just seems really sad to think that a 20-year-old has to make a decision to opt in or opt out when they don't even believe they're going to turn 30, like they have no sense of retirement. So my question really is on the opt-in, opt-out. I understood that if you opt out, you have to opt out into a personal paid LTC, correct?
Yes, that's correct.
And then what I heard you say is different than what I've read, Mary. I heard you say that if you, like I'm 65, I'm going to have to either take this program and pay the payroll tax or opt into another long-term care plan, even though I'm planning on retiring in a year. Is that correct?
That's correct, yes. So you can pay that tax for a year, or you can purchase your own policy. You have to have the state program in place. The first claim can't come until 2025. So 3 years paying the tax before you can make a claim. And it's just not people that are turning, 65 or 62, whatever it might be. There could be somebody that's 45. They would be eligible when they're 48. So you have to pay into the program for 3 years in order to be eligible.
Gotcha. And one last question. Are you recommending as a business that we look into a long-term group policy that can be offered to the employees and the employees are paying it, but that we're in essence pulling it together for them?
Andy, you want to field that one?
Yeah, Priscilla, yes. We'd like to give you the analysis, give you the option. The state's giving you this window and opportunity to do so.
Okay.
So I think you should absolutely take advantage of it because you only have a few months to do it. So you have one chance to make that decision or not. The unfortunate problem is, for like your organization, you don't have the number of employees to qualify necessarily for that rate kind of break. But then we talked about more of the portability. There's a lot more options in the private sector that do have that. There is just not a lot of options, and that's what Steve was talking about. Is just the marketplace is totally has collapsed. There's just very few options out there for actually long-term care.
Right.
Obviously, disability is a different deal, but the long-term care is the one it's difficult out in the marketplace. So we basically have scoured it. Mary has been doing research for months trying to find the right vendors and the right options for that. And so on the group side, we have selected a vendor that does an income analysis for the employees, and that way they can make that decision. And as an employer, you should be essentially given them, given a choice at some point, and this is your only opportunity to do so.
And-
so we're hoping that businesses do look at it, whether or not you purchase it or not. That's not, at least you've made the right decision in 2021 going forward. So,
Right. So if we purchase that and it's the employees who are paying into it to pay for that, employee leaves, they still have that group insurance with them as long as they're paying they're going to pay the premium, right? The agency isn't.
Correct. You could decide to pay a portion of it if you want to as an agency, but you don't have to.
So we're just kind of setting it up for them.
Right, and doing the payroll deduction to make it easier.
But if they all opt out and opt into paying for long-term insurance themselves, then they would be paying this premium that we as an agency have pulled together.
Yes.
Okay. Okay.
So either way, the employee's going to spend money. They're going to pay the payroll tax, or they're going to pay for a private policy.
Right. And then when they move on, that policy goes with them.
Yes. And they will be responsible for continuing to pay that premium.
And then the only employees we will ever have to have a discussion with are employees who are brand new to the workforce, because everybody else would have either opted in some way or opted out.
If they're not in the workforce or are under the age of 18,
right,
they are forever paying the tax. So you could have somebody move in from out of state and they would not be able to join your group plan. They would still have to pay the tax.
Okay. Okay.
Well, they could
great.
join the
Thank
group
you
plan,
so
but it doesn't qualify as a waiver. So
correct.
It doesn't qualify as a waiver. They can totally join the group plan and get the portability of having a separate plan beyond the state plan. It just doesn't qualify for the waiver. So
right. It would then be paying two.
Yes.
Yeah.
They could.
Okay.
Conceivably, yes. Yeah.
Okay. Thank you.
So can I clarify something here? So if someone is not in the workforce this year, but next year enters the workforce, they have no choice but to pay the payroll tax and receive the long-term care benefit of the state. As
it stands now, yes.
Okay.
It may, little changes have been made along the way. And particularly over the last 6 months or so, there have been small changes.
Mm-hmm.
I can't say whether or not those changes would happen. Steve, I think, would have a better idea of how often those things go for amendment.
Yeah, if I could, Colleen, Mary's right. There's two commissions that oversee this program. One is a policy commission that looks at, the policies and the guidance on the program coverage. And then there's a fiscal or actuarial commission that sort of deals with the rates. One of the things that sort of impacted some of the changes that we did in the legislative session this year is, I don't know if folks remember, but there was on the ballot last year an ability for the trust to be able to invest in equities. And I can't remember what the initiative number was, but that failed. And that limited some of the investment potential of the trust. So that's why some of the premium dates were moved up a little bit as to when this cutoff date was. It was going to originally be December and it was moved up to October because the actuarial numbers were challenging, because the trust was not able to invest in equities. That I'm sure, or I'm not sure, the legislature will probably take a look at that in subsequent sessions. And as I think the program gets more established, just as, and I'm sure Andy and Mary can speak to this, as the insurance gets established, the revenue gets established, and we can kind of see what the actuarials are of the trust, there should be more flexibility. The idea right now, it's pretty stringent, I would say, as Mary and Andy have pointed out, but that's to make it viable for the folks that are coming in. Hopefully, as it gains acceptance and some experience, it'll hopefully become more viable and becomes, again, sort of a basic alternative, sort of that baseline for long-term care, with the private sector providing, additional products that supplement it or meet some of these gaps that both Mary and Andy have talked about. But you're right, Mary, it's going to ongoing review by these two commissions, actually, that are overseeing the long-term support care trust.
Mhm. Okay, so let's see. Donna, you wanted to ask something, and then Linda.
Yes, of course, Colleen, we own a very small business. We're 73 and 79. We just signed a 5-year lease. So if we vest, we are now forced to go into this. We're too small for a private plan. So we have to vest for 3 years. We have no way to opt out. Is that correct?
That's correct. You either pay the tax or you have a private long-term care policy.
So in our case, 36,000 is actually nothing for, especially at our age, that doesn't really take care of much for ADLs at our age. That's really insignificant. We're already taking care of a mom in hospice, and that's not much for an assistance plan, I think, as you guys mentioned. But at our age, to pay 58 cents per 100, that's probably not a bad deal for us. But for one of our employees who's 26, that's a significant amount for her lifetime to go to the 36,000. So I would hope there would be some adjustments in the program. And I think I had another question. Colleen, do you see another question that I had on there?
Nope, but I'll let you ask. Oh, about S corp owners.
Oh, yeah. I think I rolled that in there
Okay.
with S corp, and with just a small number of employees, it looks like we just don't have any other options. Are there any challenges to this? I'll go back to the days of the Boston Harbor taxation without representation. Are there any challenges to this program?
Andy, I'm throwing that one over at you.
I don't know. I mean, I don't know of any at this point. I don't represent the Tharinger. Is there anything that you want to say on that in that regard?
Well, I will say there were some fairly robust conversations within the legislature this session as the bill, moved through 1323 to sort of adjust it. But the general feeling is that the need is great, and this is a baseline, program that will provide. You're right; it's not going to provide, $4,000 a month in a long-term care facility, but it will. Again, as I said earlier, the idea is for folks that can't participate in the higher end market and want to age in place. This probably adds an additional couple years of being able to stay at home with care. And that was kind of the target. I mean, as the program grows, it could be expanded. And again, hopefully the private sector can provide some, supplemental programs like Medicare Advantage that fill in some of these gaps. But the actuarial studies I've seen, if you're putting in $9,000, you're going to get 32 grand out, if you're sort of for this 20-year-old or whatever that's in there for the life of the program. So that's not a terrible return, right? For a guarantee that you will have some money to be able to stay at home when you need those services, those daily need services. So,
there's one disconnect I'm not quite understanding here. I heard from Mary that the provider needs to be approved by the state, but then Steve, you've talked about, aging in place and staying at home. Is it that provider would need to be qualified by the state and then they would come and be an in-home provider?
Yeah, I'm not sure exactly what Mary's talking about there. I know that these dollars can be used for family members to provide care. I think if you're going to go to a facility, then that facility needs to be certified by the state. I don't know if it has to be approved or whatever. But as folks know, those costs are super high in facilities. So again, the program is really targeted to be able to keep people at home, which we think is better for the person that's aging, and also, it's less expensive.
And yeah, that's my understanding, is that the providers are approved by the state, and that certainly could be a family member. There's a certain training curve they need to complete before they could be paid, but that would be a godsend to a lot of people to be able to pay the family member to keep you at home.
Okay, Linda, you had a question or a comment as someone that does manage a bunch of home care providers, right?
Yes, yes. And my comments are that many of our people, like Steve said, want to be at home. And if you're a family caregiver, or even if you're a respite provider for that family, this would be very helpful. And it's not that expensive when you look at the whole scheme of things. I also have not been able to get private insurance for my people, just for health insurance. So I'm a little worried about what the insurance companies are going to be charging, and how that may be palatable today, but may go up as we go. So you can get a lot of respite, or someone coming in a couple hours a day, or for over quite a long time with $30,000. So I'm just saying, I think it looks viable to me, and I worked out how much I'd be paying, and it's not that much per month. And other people with lower salaries are going to be paying less. So I don't know. I just want to say that it's not just that you're going to go into a long care facility, which would totally eat it up in not very long. But there are other options out there. If we could find employees, that would be a wonderful thing. But hopefully that'll change too.
Okay, thanks, Linda, for that perspective. And then Michael, you had, I think, a pretty good question there. You want to ask that?
We talk about a $32,000 or $36,000 lifetime benefit, $36,500 lifetime max benefit. If someone buys a private long-term care policy, what's the typical claim paid out in a year on one of those? And what are the lifetime caps on privately held long-term care insurance for comparison?
I think maybe one of the easiest comparisons would be to meet the benefit that will be offered by the state, and with a life insurance policy with a long-term care rider, you would purchase a $40,000 life insurance policy with that rider. So if we try to apple it to the state plan, it would just be just over $100 a day for that. The typical long-term care claim is 3 years. And so 36.5 is not going to last 3 years. So that's why people are going into private plans. You don't have to get just $40,000. You could purchase more to last a longer period of time. And then the other thing about the group plan, if you enter a group plan and you're 22 years old today, when you're 65, you're still going to be paying the premium of a 22-year-old. So at 58 cents at your current salary, it might be quite low, but our salaries tend to go up over time. So over time, you're going to be paying more in than just 58 cents on what you're earning at age 22.
So a 22-year-old then, would they be paying more or less than 58 cents?
It's based on salary, but what I've seen so far is those younger employees will pay less than what the actual tax is. To me, the whole decision is, how do I want to spend the money? Do I want to spend the money in the state program, or do I want to spend the money in another program? And mentioning what Steve said about there being eventual supplements to the state program, that would be a great option, like a Medicare Advantage plan, if that would be available.
Mm-hmm.
But those probably won't hit the private marketplace until multiple states adopt the same plans. I mean, a similar plan to what Washington is doing, because it's just like Medicare supplements, you have the entire country participate in that. So until other states adopt a similar plan, we just won't have the marketplace won't have the demand to say they can make it work on the other side. The 0.58% is a starting point. We don't know. That's what the actuaries present. And a year from now, they might have miscalculated the inflation on cost of care. And so I know that I probably ran those numbers, but maybe that's not enough, and we're not even charging enough to get the 36.5 or whatnot. So there is an absolute need for what's put in place. It's just a matter of having choice as a consumer, or as a Washingtonian. So go ahead, Colleen.
Got it. So it seems like it's hard to characterize your average person in Clallam County, but so at what point, where's that tipping point where it makes sense for someone who is fine with the amount of benefit that the Washington Cares program provides? Where's that general tipping point for a healthy person that they ought to look at an outside plan rather than what the state offers? Is it 50? Is it years old? Is it, have you looked at that based on today's expectations?
There's the two factors that have to be balanced in there: how old someone is when they purchase the policy, and how much they're making when they purchase a policy. So I can't say that the average age to purchase a long-term care policy anywhere is between 45 and 55. So that's when people tend to make the decision to insure that part of their coming retirement.
Okay, so that 50-year-old that is healthy, that's making an average wage in our county, I know it's not 50,000, but let's say it was, are they better off going with the state plan or with a private plan?
That's hard to say. It really is. It has to be run through the algorithms to see, and that's why we're here. We can do those comparisons for you.
But generally speaking, it's if you're younger, for the younger population, really generally would probably want to look at alternatives. Whereas if you're older, then likely the state plan would be better for you, unless you hit that point where you're getting ready to retire or past the age. Is that right? Is that a fair analysis?
Well, Colleen, some of the numbers, if I could, some of the numbers I looked at, the average, I think the typical median earner in the state is around 52,000 in 2018. They'll pay about $302 per year. And for a 30-year career, that's about $9,000 for a $36,500 benefit. So I think one way to look at it, and Andy is really right, that there's this supplemental market I'm speaking about is not developed, but this is a baseline, right, for folks that don't have any long-term care. I mean, 50% of the people retiring right now have only about $25,000 in savings. And more than a third of all folks, working adults have no retirement of savings. So this is a forced savings. It's like Social Security. You're being forced to put money in to meet an obligation that's going to come because you're living longer, an obligation that's actually going to fall on all the taxpayers in Medicaid, right? If we don't do that. So there's no question about it. It's an employee, payroll tax, but it does pencil out for a very basic amount of care. And the problem is a lot of folks don't have any options right now. And so it is a little, as Andy and Mary have questioned, it's really squeezed, right? These are big decisions in some respect to be made in the next few months. But if you look at the dollars and cents, it's not, you know, it's not, it's 5 cents per 100,000. It's not that big a deal. And I think it's not probably, it needs to be supplemented with something else, right? So, and it does depend on, I think, a little bit, and Andy and Mary work these numbers all the time, right? Because that's what insurance does, is to do all the actuarial stuff. I think it, you know, I think it makes some sense as a basic sort of savings for long-term care.
Mm-hmm.
And that's how it's designed.
Okay. Thank you. What percentage of people actually need and qualify for the long-term care in coverage, the benefit?
So the average is 7 out of 10 people will need some
Okay.
type of service in their lifetime.
Okay, got it. All right. Well, I think that covers most of the questions, and we are well after 9 o'clock. Someone did just throw something in the chat. So Michael, do you want to ask your last question, and then we'll call it a morning?
Well, I'm just wondering, you know, to what extent they talk to retirees about this, or people who are seniors who are in the workforce. As a senior center director, I've got 3 employees over 65 already. They are not sure, none of them are sure they're going to want to keep working for 3 years or more. And so it's very highly possible that they will retire in 1 or 2 or 2.5 years and not be eligible to get any of the benefits for the taxes they're paying in. And then let's say they do hold out till age 68 or 69 and retire, and they've got the 3 years of eligibility, but then they don't have a claim till they're 74 or 75, which is more typical than 69 or 70. They don't have a claim till they're 80 years old or whatever, then they won't, my understanding from Mary's explanation is they won't have access to this either. So it just seems like there's a number of things that need to be tidied up about this to be fair to people. So I'm concerned about fairness and, you know, equity and all that stuff. Thanks.
And Colleen, if I could, you know, we looked at this, we looked at trying to make it, people could opt in, right? Older folks could opt in, people like myself, for example. But it doesn't pencil, quite frankly. It's too much of a demand on you know, the actuarial solvency of the program. And so at this point, you can't opt in if you're an older employee or an older worker. It's just that's one of the challenges here, to try to figure out how to make this work for older populations.
Got it. Okay. Well, thank you so much, Representative Tharinger, for joining us. I think your perspective has been really, really valuable because you were obviously incredibly knowledgeable, involved with the process. So thanks so much for joining us and giving us the information that you have today. So I'm sure there's going to be 100 other questions, and Mary and Andy are both available to answer those questions, and we'll provide an opportunity for you to compare the different options. So with that, I